A policy limit is the maximum the insurer may pay for a covered claim or category. In real life, the loss can be real, covered, and documented, yet still exceed the amount promised in the contract. One ordinary version is a liability claim costing $300,000 when the policy limit is $100,000. The practical lesson is that coverage can run out before the bill ends. Limits can apply to the whole policy. Under the surface, an overall limit caps total payment for a policy period or major coverage section. Think of a business policy with an annual aggregate limit being reduced by multiple claims in 1 year. The viewer should remember that past claims can affect what remains available later. Limits can also apply to specific items. The practical engine is simple. Jewelry, electronics, cash, art, bicycles, or business equipment may have sub-limits. Picture a home policy covering contents but limiting jewelry theft to a small amount unless scheduled. Once you see that, special property often needs special attention. Per claim limits and aggregate limits are different. Mechanically, one controls each incident, while the other controls the total paid over time. This shows up when a professional policy paying up to a set amount per error and a separate maximum for all errors that year. That small detail changes the decision because both numbers matter when risk can repeat. Liability limits protect against claims from other people. The process works because medical bills, legal defense, property damage, or court awards can exceed expectations. You can see it when a guest slipping at a rental property and suing for injuries above the onera €S low limit. This matters because liability limits should match worst-case exposure, not average accidents. Property limits should reflect replacement reality. The hidden lever is that building costs, materials, labor, debris removal, and code upgrades can push rebuilding cost higher than expected. For example, a house insured for an old purchase price instead of current rebuilding cost. So the useful takeaway is that market value and rebuilding cost are not the same thing. Medical limits can matter while traveling. The moving part is this: hospital costs vary widely, and low travel medical limits can disappear quickly in serious emergencies. A simple example is a tourist needing surgery abroad and exhausting a small emergency medical limit. The result is that limits should be judged against where the loss might happen. Deductibles and limits work in sequence. What changes the outcome is that the deductible reduces what is paid, while the limit caps the maximum eligible payout. A realistic case is a $20,000 covered loss with a $1,000 deductible and a $10,000 limit leaving a gap. That is why both numbers can reduce your recovery. Cheap policies often have lower limits. In real life, lower limits reduce the insera €S maximum exposure and can reduce premiums. One ordinary version is choosing low auto liability coverage to save money and later facing a large third-party claim. The practical lesson is that saving premium may transfer a bigger leftover risk back to you. Inflation can make old limits weak. Under the surface, medical costs, construction materials, car parts, and legal costs can rise after the policy was first chosen. Think of a contents limit set years ago no longer covering current furniture and electronics prices. The viewer should remember that limits need review, not just renewal. Co-insurance clauses can punish underinsurance. The practical engine is simple. Some policies require you to insure a property to a certain percentage of value or accept reduced claim payment. Picture a commercial building insured far below required value receiving only partial claim settlement. Once you see that, too low limits can reduce even smaller claims. Umbrella policies add extra liability capacity. Mechanically, they sit above underlying policies and can respond when primary liability limits are exhausted. This shows up when a serious accident claim exceeding auto liability and triggering umbrella coverage. That small detail changes the decision because extra limits can protect assets from rare large claims. Sub-limits can surprise people most. The process works because a policy may show a big overall limit while quietly capping certain losses. You can see it when a cyber or water damage extension limited far below the main property amount. This matters because the headline limit is not the only limit. Policy limits should match your exposure. The hidden lever is that assets, income, dependents, business contracts, property value, and legal environment affect how much protection is sensible. For example, a landlord with multiple tenants needing different liability thinking than a single renter. So the useful takeaway is that limit selection is personal risk design. Lenders and contracts may require minimum limits. The moving part is this: mortgages, leases, vendors, or business partners can demand specific insurance amounts. A simple example is a commercial lease requiring liability coverage before keys are handed over. The result is that outside agreements can set the floor for coverage. The right question is not only what is covered. What changes the outcome is that ask how much is covered, for what event, for which item, and over what period. A realistic case is checking theft, liability, building, contents, and medical limits separately. That is why limits turn broad coverage words into actual numbers. If a limit feels abstract, imagine the worst believable bill. In real life, estimate replacement, legal, medical, repair, and temporary living costs instead of choosing a random number. One ordinary version is pricing a kitchen fire by adding repairs, hotel stay, smoke cleaning, and damaged appliances. The practical lesson is that realistic scenarios make limit choices clearer. Policy limits mean insurance has edges. Under the surface, inside the edge, the policy can be powerful. Outside it, the remaining cost may return to you. Think of a covered claim still leaving unpaid amounts because the limit was too low. The viewer should remember that buying insurance means choosing the size of the promise, not just the type of promise. A policy limit is the maximum amount the insurer may pay for a covered loss. That sounds simple until the loss is larger than the limit. If a liability policy has a limit of $100,000 and the covered claim costs $150,000, the remaining amount may become the customary Euro-S problem. Coverage can exist and still be insufficient. Limits can appear in different places. There may be an overall policy limit, a per incident limit, a sub-limit for jewelry, electronics, temporary accommodation, or medical costs. A person may think, a Euro OEME policy is worth a large amount, a euro, but a specific category may have a much smaller cap. The small print can control the real payout. The right limit depends on the size of the risk, not just the cheapest premium. A renter with basic belongings may need less property coverage than a family with expensive equipment. A homeowner in a high-cost repair market may need enough coverage to rebuild at today's Euro-S prices, not at the price they paid years ago. Policy limits matter because they define the ceiling of the promise. The question is not only, a euro EMI covered, a euro it is, a euro O covered up to what amount, for which category, and in which situation. A euro. Once you ask that, insurance becomes easier to judge. A low premium may look attractive, but a low limit can leave the largest risk still sitting with you.